While the rest of the country holds its breath over tax hikes and budget uncertainties, something unexpected is happening in the UK property market. House prices aren't just holding steady, they're climbing, defying every economic forecast and leaving experts scratching their heads. What's driving this surge when everyone predicted a downturn? If you want to stay ahead of the UK's property landscape and understand where the market is really heading, hit that like button and subscribe to Property Reporter. We're bringing you the facts that matter, cutting through the noise to keep you informed on everything shaping Britain's economy and housing sector. The numbers tell a story that contradicts everything we've been hearing. Despite Rachel Reeves announcing one of the most significant tax increases in recent memory, property values across the UK have climbed by an average of 2.4% in just the past month alone. Nationwide's latest data shows the typical home now sits at £265,000, a figure that's left economists scrambling to revise their predictions. This isn't a minor fluctuation or statistical anomaly. We're witnessing sustained growth in an environment that should theoretically be crushing buyer confidence. What makes this even more intriguing is the timing. The autumn budget dropped some serious tax bombshells on landlords and property investors. Stamp duty changes, capital gains adjustments, and inheritance tax modifications were supposed to cool the market instantly. Industry analysts had positioned themselves for a correction, with many predicting price drops of up to 5% through the first quarter. Instead, the market responded by accelerating upward. First-time buyers who delayed purchases expecting bargains are now watching properties they could afford slip further from reach each passing week. The mortgage market is painting an equally surprising picture. Lenders have been locked in an aggressive rate war, slashing their offerings to levels not seen since early 2023. The average 2-year fixed-rate mortgage has dropped below 4.5%, while 5-year deals are hovering just above. These reductions came at precisely the moment when rising taxes should have made lenders more cautious. Instead, they've opened the floodgates. Applications have surged by nearly 30% compared to the same period last year, with approval rates remaining strong despite stricter affordability checks. Banks are clearly betting on continued market strength rather than the downturn everyone anticipated. Regional variations reveal the complexity beneath these headline figures. London has actually cooled slightly, with annual growth of just 1.1% as higher stamp duty thresholds bite into the capital's premium market. Meanwhile, northern regions are experiencing double-digit gains in some postcodes. Manchester and Liverpool have seen prices jump by 7% and 8% respectively over the past 3 months alone. Scotland's market is running even hotter, with Edinburgh and Glasgow recording their strongest quarterly performance in over a decade. The traditional north-south divide is inverting in ways that would have seemed impossible just 2 years ago. First-time buyers are facing a particularly brutal reality. While headlines celebrate rising property values as signs of economic resilience, those trying to get onto the ladder are watching their dreams stretch further away. The average deposit required has increased by nearly £15,000 in the past year, pushing the goalposts back for thousands of households saving diligently. Government schemes designed to help have been overwhelmed by demand, with the mortgage guarantee programme exhausted within weeks of each funding renewal. Young professionals in their 30s are increasingly accepting that home ownership might not happen until their 40s, if at all. The psychological impact of this shift is creating a generation with fundamentally different expectations about wealth building and financial security. But there's a darker undercurrent that most mainstream coverage is missing. Investor activity has exploded despite the tax increases specifically designed to discourage it. Cash buyers now account for nearly 40% of all transactions, up from 32% just 6 months ago. Many of these are portfolio landlords accelerating their acquisitions before additional restrictions potentially come into force. They're calculating that current tax hits are preferable to what might be coming next, especially if Labour remains in power through multiple terms. This rush of investment capital is artificially inflating prices in specific markets, creating mini bubbles that could deflate rapidly if sentiment shifts. The risk isn't being priced in because everyone's focused on securing assets now, rather than considering long-term sustainability. rental markets are experiencing their own crisis that's feeding back into purchase prices. Average rents have climbed by 12% annually in most major cities, with some areas seeing increases of over 15%. Landlords are passing their increased costs directly to tenants, who have virtually no negotiating power in a market with record low vacancy rates. This is creating a perverse incentive structure where renting becomes so expensive that buying appears attractive even at inflated prices with higher interest rates. People are stretching their finances to breaking point just to escape rental increases, taking on mortgage commitments that leave no buffer for unexpected expenses or rate rises. The system is pushing households into precarious positions while rewarding those already holding property assets. Immigration patterns are playing a role that's politically sensitive but economically significant. Net migration remains at historically high levels, and new arrivals need somewhere to live. Social housing stock has been decimated over decades, meaning the private sector absorbs this demand. University cities are particularly affected, with student accommodation shortages pushing international students into the regular rental market, which then squeezes local residents upward into purchase markets they weren't planning to enter. This isn't about blame or politics. It's simple supply and demand mathematics. The UK is adding population faster than it's adding housing units, and that gap widens every quarter. Construction activity tells another part of this puzzle. House builders reported that new project starts dropped by 18% following the budget announcement. Increased costs from employer national insurance contributions and material price inflation have made marginal developments unprofitable. Planning delays continue to strangle supply in areas with the highest demand, with some applications taking over 2 years for approval. 6. A government's ambitious target of building 1.5 million homes over this Parliament looks increasingly fantastical when current trends suggest we'll struggle to reach even half that number. Every home not built today is another household competing for existing stock tomorrow, perpetuating the cycle that keeps prices elevated regardless of economic headwinds. Bank of England policymakers are watching these developments with growing unease. Their primary tool for controlling inflation is interest rates, but the property market is responding to structural supply shortages rather than monetary policy signals. They're caught between needing to support economic growth and preventing a property bubble that could destabilize the financial system. Minutes from recent meetings show deep divisions about the appropriate path forward. Some members argue for maintaining higher rates longer to cool asset prices, while others fear that approach will trigger the recession that rising property values have so far helped us avoid. The wrong decision could either inflate a bubble to dangerous levels or pop it prematurely with devastating consequences for household wealth. International money is flowing into UK property at volumes not seen since before Brexit. The pound's relative weakness against the dollar and euro has made British assets look attractively priced to overseas investors. Wealthy individuals from the Middle East and Asia view London property particularly as a stable store of value, despite the recent cooldown in the capital's market. They're playing the long game, securing assets in a globally significant city while prices are below their 2019 peaks in dollar terms. This foreign capital props up the premium end of the market, which then sets price expectations that filter down through all segments. A Saudi investor paying $3 million for a Knightsbridge flat influences what a buyer in Kent thinks is reasonable for their semi-detached. The generational wealth transfer happening in background is another accelerant. Baby boomers are sitting on unprecedented property wealth, with many owning homes worth 10 to 20 times what they paid. They're increasingly helping children and grandchildren with deposits, injecting family wealth into the market at precisely the moment when tax changes were supposed to dampen activity. This bank of mum and dad now finances nearly 30% of all first-time buyer purchases. It's creating a two-tier system where those with family wealth can access home ownership, while those without face increasingly impossible barriers. The social implications extend far beyond property markets into fundamental questions about opportunity and social mobility in modern Britain. Energy efficiency requirements are adding unexpected complexity. New regulations requiring higher EPC ratings for rentals and, eventually, for all property sales are forcing owners to invest thousands in improvements. Properties with poor ratings are being discounted heavily, creating a bifurcated market where efficient homes command significant premiums. Some older properties are becoming effectively unsellable without major renovation investment. This is accelerating a shift in buyer preferences toward newer builds and recently renovated stock, leaving segments of the traditional housing market stranded. The environmental necessity of these changes is clear, but the transition is creating winners and losers in ways policymakers didn't fully anticipate. What happens next depends on factors beyond any single policy or economic indicator. Consumer confidence remains fragile despite rising property values, with many households reducing discretionary spending to maintain housing costs. Credit card debt is climbing steadily as people use borrowing to bridge the gap between income and expenses. Arrears on mortgages remain low for now, but they're ticking upward from historic lows. The system appears stable on the surface while stress builds beneath. Any significant shock, whether a major employer relocation, an unexpected rate spike, or a global economic downturn, could shift sentiment rapidly. Markets that seem unstoppable often reverse with stunning speed when the psychology changes. The gap between political rhetoric and market reality has never been wider. Government ministers talk about making housing affordable and helping first-time buyers, yet every policy response seems to inflate prices further. Help to Buy schemes inject demand without addressing supply, pushing prices higher. Planning reform is promised, but never delivered in meaningful scale. The uncomfortable truth is that falling house prices would devastate the wealth of the majority who already own, creating political risks no party wants to accept. We're locked in a system where the solution to a housing affordability crisis would crater the finances of millions of voters. No wonder politicians prefer tinkering at the edges rather than addressing fundamentals. Looking at the data dispassionately, this situation cannot continue indefinitely. Prices cannot rise faster than incomes forever without eventually breaking something. Either wages must rise dramatically, house prices must plateau or fall, or we accept a permanent underclass locked out of ownership. Each option carries profound economic and social consequences. Rising wages without productivity gains fuel inflation, requiring interest rate increases that make mortgages unaffordable anyway. Falling house prices destroy household wealth and potentially trigger financial instability. Accepting permanent renting as the norm for large portions of the population requires a complete reimagining of retirement planning and wealth building. None of these paths is easy or politically palatable. The resilience of UK house prices despite budget tax fears reveals something fundamental about how our economy functions. Property has become the primary vehicle for wealth accumulation and retirement funding, intertwining housing policy with financial stability in ways that make reform extraordinarily difficult. We've built a system where housing must appreciate to fund retirements, yet that appreciation makes housing unaffordable for the next generation. It's a paradox with no simple resolution. Understanding this dynamic is crucial for anyone trying to navigate the market, whether as a buyer, seller, investor, or simply someone trying to understand where Britain's economy is really heading beneath the headlines and political spin.